Hello everyone. Thank you for joining our webinar. This is Alan, Senior Audit Manager. Today we are going to share with you all about Hong Kong tax case studies. During our webinar, for any questions, you may drop your message on the chat box at the right-hand side. We will answer the question in Q&A session at the end of today's webinar or share the relevant information afterward. And you can also click the live chat red button on the top to make an appointment with us for further discussion or consultation. Now, we will start our today's webinar. The first topic is offshore income claim. Under most countries, Hong Kong adopts territorial basis of taxation. That means only business profit, employment income, and property rental income arising in or derived from Hong Kong is taxable. It applies to both residents and non-residents of Hong Kong. Although the concept of locality of sources of income seems simple, in reality, its application often can be complex. No universal rules can be applied to every scenario. Whether business is operated in Hong Kong and whether the profits are derived from Hong Kong are determined by facts and depends on the nature of profits as well as of the transaction which give rise to such profits. Not all taxpayers' operations are relevant to determine the source of profits. The key is focusing on the location of profit-generating activities as distinct from incidental activities such as accounting and auditing. A Hong Kong company may apply for offshore income claim if it meets the following prerequisites. First, it has no business operational office in Hong Kong and only use administrative office as a Hong Kong registered office. And second, it has no staff in Hong Kong and its directors and staff seldom come to Hong Kong. Some general rules of service income and trading profits are discussed as below. The source of service income is the location where the services are performed, which give rise to the income. The place where incidental activities were performed prior or subsequent to the earning of service income are generally not referenced to determine the source of profits. The factor that determines the source of trading profits is generally the place where the contracts of purchase and sales are effected. Some reference points for consideration are listed below. First, where the suppliers were procured, where the purchase orders were initiated, processed, and placed with the supplier, where the purchase contract was negotiated, prepared, and signed, where the customers were solicited, where the purchase order from customers were initiated, processed, and placed with the taxpayer, where the sales contract was negotiated, prepared, and signed, and finally, where the goods are stored and the shipment was arranged. All Hong Kong companies have legal obligations to do tax reporting to Hong Kong Inland Revenue Department, RRD, even the companies are eligible for applying the offshore income claim. Please note that offshore income claim is not automatically given by RRD. Moreover, offshore income claim is a year-by-year basis exercise. In other words, successful offshore claim in 1 year does not automatically guarantee an offshore claim in other years because the companies may change its mode of operation. Taxpayers can submit a claim for offshore income together with its audited accounts and profits tax return to RRD. After receiving the application of offshore income claim, RRD will assess the case and usually will raise queries regarding to the details of taxpayers' mode of operation and request taxpayers' transaction documents of some representative transactions in order to support the offshore income claim. Let's turn to the Certificate of Residence Status. Hong Kong has concluded more than 30 bilateral comprehensive tax treaties. In order to enjoy tax benefits under these treaties from other jurisdictions, Hong Kong companies may be required to apply a Hong Kong Tax Residence Certificate, that is, Certificate of Residence Status from Hong Kong Inland Revenue Department. For example, under the tax treaties between Hong Kong and China, tax will not be charged more than 5% of the gross amount of dividends if the resident is a Hong Kong company directly owns not less than 25% of the capital of the company in China. Moreover, tax will not be charged more than 7% of the gross amount of interest income. However, Inland Revenue Department takes a more strict approach to issue the certificate of resident status in order to avoid treaty abuse. It generally requires the company to have its management or control lawfully exercised in Hong Kong for granting a certificate. The following factors are generally used to determine place of management or control. First, whether directors have a place of residence in Hong Kong. Second, the place of board meetings. Third, whether the company has employees in Hong Kong and their duties. Fourth, whether companies have physical office or fixed place of business in Hong Kong. If in the Revenue Department cannot conclude the management or control lawfully exercised in Hong Kong from above factors, the certificate of residence status will not be granted. The certificate is valid for 1 year and renewed on a calendar year basis, except those issued under the Hong Kong and China Double Tax Agreement, which can prove the Hong Kong tax resident status for that year and the succeeding 2 years. Next topic is two-tier profit tax rate regime. The standard profit tax rate in Hong Kong is 16.5% for corporation and 15% for unincorporated business. On the other hand, two-tier profit tax rate has introduced for corporation and unincorporated business with effect from the year of assessment 2018 to 19. Under the two-tier profit tax rate regime, the profit tax rate for the first 2 million Hong Kong dollar assessable profits will be lowered to 8.25% for corporation and 7.5% for unincorporated businesses. Assessable profits above 2 million Hong Kong dollar will continue to be subject to the rate of 16.5% for corporations and standard rate of 15% for unincorporated business. All entities with profit chargeable to profit tax in Hong Kong would qualify for the two-tier profit tax rate, except those with a connected entity which is nominated to be chargeable at the two-tier rates. For 2 or more connected entities, only one of them may elect the two-tier profit tax rates. Let's discuss about the connected entity. An entity is a controlled entity of another entity if one of them has control over the other, B, both of them are under control of the same entity, or C, in the case of the first entity being a natural person carrying on a sole proprietorship business, the other entity is the same person carrying on another sole proprietorship business. Generally, an entity has control over another entity if the first mentioned entity, whether directly or indirectly, through one or more than one other entity, A, owns or controls more than 50% in aggregate of the issued share capital of the later entity, B, is entitled to exercise or control the exercise of more than 50% in aggregate of the voting rights in the later entity, or C, is entitled to more than 50% in aggregate of the capital or profits of the later entity. For taxpayers with connected entities, the nominated entities may make the election by declaring in its profit tax return or individual tax return that it is chargeable at the two-tier rates for the relevant year of assessment, whereby no other connected entity elects to be so chargeable. Once the election is made, it is irrevocable for that year. However, a different connected entities may elect the two-tier profit tax rate for a different year of assessment if all conditions are met. Please be aware that heavy penalty may be imposed for making an incorrect return without reasonable excuse. Additional assessments will be raised on the taxpayer on the basis that the two-tier profit tax rate do not apply. Now, let's take a look of Hong Kong profit tax treatment of depreciation allowance. Accounting depreciation is not allowed for tax purpose. Instead, tax depreciation allowance are available for capital expenditure incurred on the construction of buildings or structures and in the provision of machinery and plant for trade or business purpose. For the individual buildings and structures, an initial allowance of 20% in addition to an annual allowance of 4% of the cost of construction or the purchase from a developer is granted for an industrial buildings or structures occupied for the purpose of a qualifying trade. For other buildings and structures, that is commercial buildings and structures, an annual allowance of 4% of the capital expenditures incurred on the construction is applicable. Regarding to the plant and machinery, an initial allowance of 60% of the capital expenditure on plant and machinery is given for the year of assessment during the basis period in which the expenditures is incurred. An annual allowance is also given for depreciation at the prescribed rates of the reducing value of each of the three depreciation rate pools. The three prescribed rates are 10%, 20%, and 30%. And the reducing value of each of the three depreciation rate pool is original cost less than initial and annual allowances and sales proceeds. Today's final topic is withholding tax. There's no withholding tax on dividend distribution and interest payments from a Hong Kong entity. On the other hand, specific types of payments are subject to withholding tax in Hong Kong. They are royalties paid to non-residents and fees paid to non-resident entertainers or sportsmen for their performance in Hong Kong. Next, I will provide further details about royalties paid to non-residents. According to the inland revenue audience, royalty payments made to a non-resident for the use of or the rights to use intellectual properties in Hong Kong, or whether royalty payments are deductible as pertaining assessable profit for the payer, are deemed to be taxable in Hong Kong. Royalty payments include payments which are received from 1. Use or exhibition of film, sound recording, tape recording, or their connected advertising material. 2. Use or the rights to use of patent, design, trademark, copyright material, layout design of an integrated circuit, performance rights, plant variety right, or secret process or formula. Regarding to the profit tax calculation, the normal amount deemed taxable is 30% of the gross amount of the royalties paid, resulting in an effective tax rate of 4.95% or 4.5% for a non-corporate person. However, if a royalty is paid to an affiliate non-resident and the intellectual property was owned by a person carrying on business in Hong Kong, 100% of the royalty is deemed to be taxable, resulting in an effective tax rate of 16.5% or 15% for a non-corporate person. The foreign entities are considered associates if they are corporation. 1. A person who controls the corporation, or a partner of the controller, or a relative of the controller or partner. 2. A director or principal officer of the corporation or any associate corporation, or a relative of the director or officer. 3. A director or principal officer of a controlled corporation. Finally, the payer of the royalties to a non-resident is required to withhold the appropriate tax according to the above regulations. This is the end of our presentation today. We hope that the information we have shared is useful for you to understand about Hong Kong tax case studies. Now is the Q&A time. So let us review the question from the customer first. The first question is, referred to two-tier tax rate regime, was the tax rate over 2 million Hong Kong dollar assessable profit? The tax rate is normal tax rate, that is 16.5% for limited companies and 15% for unincorporated business. Is there any withholding tax on dividend? No. Dividends paid to either a resident or non-residents of Hong Kong are not subject to any withholding tax. Does offshore income claim apply only once? Offshore income claim is annual exercise and does not automatically extend to subsequent years even the claim is successful in that year. Therefore, taxpayers should apply each year if they would like to apply the claim. Does your registered office in Hong Kong affect offshore income claim? Provided that the registered office is only for administrative purpose, such as receiving legal and tax correspondence, it does not affect the offshore income claim. My trading company sells goods to foreigner customers, but has Hong Kong supplier. Can I apply offshore income claim? No, because the purchase activities are carried out in Hong Kong, so that it is not eligible for offshore income claim. Okay, that's the questions from the live questions. Okay, the first question is how to apply offshore income claim. The offshore income claim is applied when computing the profit tax return by filling in the relevant information. Do I need to submit supporting documents for application of offshore income claim? You only need to submit a claim together with audited account and profit tax return when you apply for offshore income claim. After IRD review the application, IRD will issue query letter to request supporting documents if necessary. That's the end of our presentation today. We hope that the information we have shared is useful for you to understand about the Hong Kong tax case studies. Please feel free to contact us for any inquiry. Thank you for your time. We are PREMIA TNC and hope to see you again on next webinar. Bye-bye.